Most Canadians pay more tax in retirement than they need to. Not because they're earning too much and not because they saved wrong. It's because most retirees never learn the tax shortcut that's already hiding inside their investments. You won't hear about it from CRA. It's not going to show up on your notice of assessment, and your investment statements won't highlight it for you. But once you understand this simple tax concept, one that has nothing to do with loopholes or risky strategies at all, your retirement income can instantly become more tax efficient. Here's what people don't realize. Two retirees can both earn the exact same rate of return in their portfolio, but one of them can keep meaningfully more after-tax income every single year simply because their investments are structured differently. Same dollar amount saved, same market performance, same spending habits, but drastically different tax bills, different outcome. And this is the part that surprises people the most. Everything comes down to what type of income your investments produce. Interest income, dividends, capital gains, or tax-free withdrawals. If you get that mix wrong and your RRSP withdrawals, they get taxed harder. Your OAS gets clawed back and your retirement income shrinks many times by thousands per year. Now, if you get it right and you suddenly keep more of your money without changing anything at all, your portfolio, your risk, your rate of return, it's one of the most powerful tools and most overlooked, honestly, parts of the Canadian retirement planning system that's out there. So let's break down the retirement tax shortcut that your investments probably already contain and how it ties directly into the introduction of this. Hi, I'm Ivan Dory, owner of Solid State Wealth. If you would like to see what this could look like for you, book a time with me. The link is in this description below. So now let's talk about your investments. Your investments can be structured to legally reduce your taxes, protect your OAS, and stretch your retirement income further, all without taking on additional risk. Part 1, the big retirement mistake, thinking that all investment income is the same. Most Canadians approach their investments like this. Save as much as possible, invest in something safe or balanced, hope it grows. But here's what nobody realizes. Different types of investment income are taxed completely different in Canada. This will affect more non-registered accounts. But an example, interest income is fully taxable. Eligible dividends, they get a tax credit. Capital gains are only 50% taxable. Return of capital reduces taxable distributions. TFSA income is entirely tax-free, always will be. Same with growth inside of TFSA. Your RRSP withdrawals, fully taxable and can trigger OAS clawbacks. So imagine this, you earn 5% interest in a non-reg account. Hopefully it's more, but we'll just use that for illustrations. Your neighbor earns 5% in dividends and capital gains. Same return, same markets, same risk, but you pay more tax. Why? Well, in retirement, when you're trying to make every last dollar count, that difference can compound into tens of thousands of dollars. This is why the type of income that you receive becomes one of the most important tax levers that you have. We want to leverage that. So part 2, the retirement tax shortcut, the CRA will never advertise. So here's the shortcut. If you shift your portfolio toward income that receives preferred tax treatment, especially in non-registered accounts, as we mentioned, your retirement income becomes instantly more tax efficient. So that means we want to focus on eligible dividends, capital gains, return of capital, TFSA growth, and then of course, RRSP drawdown efficiency. We also have corporately owned life insurance for business owners, which is a big perk that they have to utilize. We want to also reduce the reliance on interest income, GIC heavy portfolios, bond funds that are held inside a non-reg account, money market ETFs that generate unnecessary taxable income. The CRA won't promote this because it reduces the amount of tax you pay. They want their tax money. But Canadians who understand it see the enormous benefits that it can have for you, especially between the ages of 60 and 75. When you're coordinating with your CPP, your OAS, your RRSP withdrawals, and your income needs. A quick note for business owners and incorporated professionals, this tax shortcut is even more powerful inside of a corp. Corporate investment income, especially interest income, is taxed way more aggressively than most people realize. Passive income inside of a corp is the largest tax bracket you'll ever face. So when business owners coordinate investment income types with tools like corporately owned life insurance, capital dividend account planning, the difference in after-tax retirement income will be huge. But it is one of the biggest missed opportunities that I see, especially for corps. So part 3, why interest income is the silent retirement tax killer. Interest income is the least tax efficient type of investment income. And yet it's the one that most retirees accidentally receive. They have GICs, bond ETFs, high interest savings ETFs, money market funds. They're pretty stale in returns, but it's the tax treatment that really gets them. Now, these products, they're okay, but only if they're held in the right account can they be okay if that's your risk tolerance. If you hold them inside of a non-reg account, here's what can happen. So I'm talking about an account outside of the TFSA or your RSP. You will pay tax on every dollar of interest that you receive. Your taxable income rises, your OAS risk increases, your marginal tax rate will spike. You pay even more tax if you don't spend the income. I see retirees with 300 grand in a GIC sitting in a non-reg account generating 4%. We can get better returns than that now, but that's not the point, I guess. But that's $12,000 fully taxable every year. Every dollar of that pushes them closer to the OAS clawback threshold. So with one simple change, moving interest income into your RSP or TFSA, if you have room, could save you thousands of dollars over a decade for sure. That's the shortcut. And there's more work to be done inside a non-reg account if you don't have room. So part 4, why dividends and capital gains are so valuable in retirement. Dividend income and capital gains don't just provide cash flow, they protect you from unnecessary tax. So eligible dividends reduce your tax bill. Eligible Canadian dividends come with a tax credit, meaning you can keep more of the income. Your taxable income rises less than expected, and it's easier to stay under those OAS thresholds for clawback. In some cases, lower income retirees can receive thousands of dollars of eligible dividends taxed at zero. Capital gains will give you control. So for cap gains in Canada, only 50% of cap gains are taxable. And the timing is up to you. You can trigger them in low income years. You can spread them across multiple years. You can use them strategically to avoid spikes in your taxable income. And then we have return of capital. It isn't taxable at first. We call them ROC. They're payments that reduce your adjusted cost base, not your taxable income. So this keeps your income low today, and it can help you manage your OAS clawbacks, your RSP or RRIF withdrawal timing, and of course, keeping your tax bracket in a manageable spot. Now, these forms of income make up the foundation of tax-efficient retirement planning. So part 5, a common retirement scenario many Canadians overlook. Now, consider a typical retiree in their mid-60s. They have 300 grand in a non-reg account, and about 70% of it is allocated to GICs and a bond ETF, earning roughly 3.8% interest, fully taxable, and of course we have the inflation eroding that part. We have an RSP worth about 450,000 and a TFSA with 95,000. So without realizing it, they were generating over 11,000 a year in fully taxable income before touching their RSP or OAS. Now, typical, but they assumed this was a safe thing to do. But in retirement, safety isn't just about investment risk. It's about tax efficiency, sustainability. Here's what changed. Interest-bearing investments were shifted into RSPs and TFSAs. So non-registered assets were repositioned toward tax-efficient dividends and capital gains. A strategic RSP drawdown was started between ages 64 and 71, and any additional room that was created was put into the TFSA for future use. Future OAS clawback risk was greatly reduced. The result? Their retirement income stayed the same, but they paid thousands less every year in tax over the following decade. No extra risk, no complicated products, nothing wild or risky or exempt, just smarter tax structure. So part 6, business owners have an even bigger opportunity. If you are an incorporated professional or business owner with a corp, the shortcut becomes even more powerful. Corporate investment income, especially interest income, is heavily taxed. Passive income in a corp, 55, 56%. But here's what business owners can do. Focus on eligible dividends and capital gains inside of a corp. It's one of the only things you can do in Canada. Use corporately owned life insurance as a tax-sheltered asset class. It is an asset. Reduce your passive income tax. Increase access to refundable dividend tax. You want those credits. Withdraw your funds more tax efficiently in retirement through that capital dividend account. And when properly structured, business owners can significantly improve your after-tax outcome. And in certain cases, converting corporate dollars into tax-efficient or tax-free personal wealth through tools like the capital dividend account. It's so smart. This is one of the most misunderstood and most effective wealth strategies in Canada. I wish more people took advantage of it. Part 7, the simple framework. Putting the right income in the right accounts. Now, this is where everything comes together. RRSPs and your RRIF, you want to hold taxable interest. Hold bonds, hold income-heavy investments, use your RRSP drawdown strategies before the age of 71. With your TFSA, world's our oyster. Hold growthy stuff. Hold anything that might appreciate significantly. Growth stocks. Withdraw your tax-free income to stay under the OAS limits. For your non-reg accounts, hold eligible Canadian dividends. Hold capital gains-oriented positions. Hold return of capital structures. This framework alone addresses a large portion of the most common retirement tax inefficiencies we see. So part 8, what you should do next. You should start with reviewing the type of income your portfolio is generating. Don't assume, check your statements. To shift your interest income into your RSPs and your TFSAs, this is the quickest win by far. Expand your exposure to tax-efficient dividends and cap gains, especially in those non-registered accounts. You also want to build an RRSP meltdown plan between 60 and 71. Avoid those big RRIF withdrawals later in life. It will be a tax killer. And 5, stress test your OAS situation. Small changes like this can save you big clawback dollars down the road. And if you own a corporation, explore corporately owned life insurance. It's one of the most powerful tax tools available. The CRA won't advertise this. They know it's a shortcut, but they want their tax money. Your tax return doesn't highlight it. Most investment statements don't help you see it. But when you understand how different types of income is taxed and structure your portfolio correctly, your money will go further. Your taxes go down, your retirement becomes way more secure. If you would like to see a personalized retirement strategy like this, please book a time with me. The link is in the description below. I'd be happy to help you.